welcome back, traders and investors. We have Michele Schneider, who's the Director of Trading, Education, and Research for MarketGauge. What do you prefer, Michele or Mish?
Mish.
Mish. Okay. Yeah, Mish. How you doing today?
Mish.
And can you tell us a little bit about MarketGauge?
Well, MarketGauge started out as a company that was doing scanning tools for real-time scanning of actually volume and price action based on opening range. They started that about 15 years ago, and it was primarily for institutional investors. But then they moved into the retail space years later, and now it has evolved when I came on board, which was about 5 years ago, to having a bevy of courses, several recommendation services, and it has really been an engine that has now fueled an asset management company, a hedge fund. So we're really full service.
Cover
pretty much
everything.
everything in the trading space.
You cover everything there, from the retail
We
trader,
do.
education to the hedge funds. So that's great. Okay, all right, Michele, you got a topic on your list that you sent me that people don't really talk about or like to talk about, and the potential for a spike in interest rates. Could you elaborate on that for me, please?
Yes. Well, basically, I have been very carefully watching. I've caught a couple of moves in the rising interest rates last year, and I noticed that what was happening last year was, as the TBTs were firming and the TLTs were dropping, the market was actually responding in kind. And then when we got into this year, there seemed to be a switch in terms of some perception in terms of that, where the market and the rates started to separate from one another, and there was more of a flight to quality where the rates started dropping. But when I went back and did some research from last year, there actually was a peak high, or I should say it's an inverse relationship, a peak low in rates last year in the fall. And so I was waiting for a second tier of a peak this year. And it comes also with some actual facts, with the Fed talking about tapering. And also I had a real sense of the fact that it seems to me that after years and years of talk of deflation, as I was watching some of the commodities this year, particularly some of the softs, and they've corrected since then, but as the year began, a lot of them were skyrocketing. And having been a commodities trader back in the day when inflation was rampant, I thought perhaps I was starting to see the signs where now we would have a new paradigm shift. Would be rates would firm. It would actually be somewhat the end of deflation, the start of inflationary talk, and actually that would have impacts on everything, negative on some, positive on a lot, as I continue to do more research. And so last week, I started noticing that the TLTs actually did a second tier sort of rally, and then actually had a blow off volume type of situation, where it made new highs for that particular swing up, and actually on the new highs did double the average volume. And that's the type of stuff that I look for from a technical standpoint. I'm a real student of volume patterns on top of a lot of other things. And sure enough, since then, and by the way, the date on that, in case you want to know, was May 2nd. So
Okay.
since then, now the exact scenarios I had anticipated happened, which is the rates started to firm a little bit, and the TLTs dropped a little bit, and now they're up here in the pre-market, probably a little bit because of the retail sales were disappointing. But it doesn't matter. If you look at it from a technical standpoint, I would expect that after 4 days down to see a little bit of a bounce. We'll see how far that bounce goes. But I actually think the opportunity right now is for more of a short in the TLTs, long TBTs. And that, by the way, was coupled with the dollar, which I also patiently waited for some real strong technical signal, which we also got last week. Looking at FXE in particular, I always like to look at the primary indicator, and then I will mirror it with, say, UUP. But that had actually left a little bit of an island top last week in FXE, and that was the type of event I was looking for the dollar. And so we saw a big drop in the euro and a nice firming in the dollar off the lows. So if you put those two together, to me, and I'm premature, and I will be the first one to say, I often see things well ahead, and so it's all a matter of timing. But it seems to me that we are going to, at some point, see a perception switch to more of an inflationary environment, and like I said, the impact will be there.
Well, so what does
And I
this?
know I'm not the only one who,
Well,
I'm
I
sorry, I was
know.
going to say,
So what does
I'm
this
not
mean for the average
the
investor, Michelle?
one who thinks that way too, because I've read some.
We've had a period
Well,
of low.
basically for the average, I'm sorry, you're cutting out.
No, I was just going to say, this is great detail and talking about the interest rates. You've had a very accommodated Fed. Inflation hasn't reared its ugly head. What should the average investor take from this?
Well, basically, what you want to look at if we're going to see rising rates and a dollar that actually starts to firm a little bit, you want to start to see that, foreign goods become less expensive. And so U.S. imports increase. So any company that relies more on importing foreign goods might do well. For example, a company like Walmart. That actually would benefit from a stronger dollar and rising rates because they buy a lot of their stuff from China. Well, many companies do in this country, and so if those costs get less, that would be a good bottom line for a company like Walmart. Also, you want to say right now we've had already started to see a little bit of a narrowing trade deficit. So that's the type of stuff you also want to look at. China actually welcomes a stronger dollar because they own so much of our debt, and then the other thing too is that as the U.S. is a leader in technology and production, with the purchasing power of the U.S. dollar gets stronger, then obviously some of these tech stocks that have been terribly beaten up and some of these manufacturing companies can start to benefit. So, the old paradigm is also the shift in that commodities get hammered when the dollar gets stronger, rates go up. But I was trading back in the 80s when we had rampant inflation. And actually, the opposite happened. Commodities started to fly because that's where the prices went. So all the soft commodities flew, the gold flew, the silver flew. So these are all the different combinations of things that you want to start looking for. Like I said, I'm a little bit ahead of the curve here. That often happens with me, but what I like to do is look for the perception to switch, be in it before the perception switches, and then as everybody starts to freak out about inflation and start to protect themselves with whatever they were going to do to accommodate that in the market, we're already involved. So that's kind of where we're at right now.
So, high inflation could be really, really bad for the market. This could, if there's anything that could put a top in the market, it certainly would be a spike in interest rates or an increase in inflation.
Well, yes, and there has been an inverse relationship between the market and commodities in the past. But actually, I did some further research. I was very interested in this topic over the weekend, and I knew we had our interview coming up, so I wanted to see some of the other guys that have really been students of this, and I looked at Larry Edelson. He's done a lot of writing on this. And actually, he said if you look historically, that the stock market have behaved very similarly, that after an initial scare, most major bull markets also occurred during periods of rising interest rates. So now you're talking about rampant inflation. I'm not looking for rampant inflation necessarily.
Okay.
I'm just saying that we can start to see talks of a more inflationary environment with rising rates, which I actually think will have a positive impact on some sectors of the market, obviously others not so much. And that's going to be where the savvy investor is going to have to look to see where that departure happens. And one thing we have seen lately is that market is totally diverse. There has been, a tremendous dichotomy in so many different areas of the market. As we know, blue chips going up, the Dow making new highs last week, as we started to see the technology stocks and the Russells and the small cap stocks getting hammered to bits. Now we had a little bit of a reckoning yesterday. We'll see if that actually follows through
Okay,
today.
I know you like to follow some commodities as well here, and crude is just been kind of in a trading range over the last few sessions, finding support around 99 and getting a little rally here. Could you give us your short-term and long-term outlook for crude oil?
Well, actually, I have to say I am long-term or intermediate to long-term pretty bullish in the oil, and that also creates havoc in certain situations. So, all of these relationships constantly have to be watched. And we're coming into today, and I'm looking particularly right now at the U.S. oil fund. That's the one that
Okay.
I haven't been trading crude oil futures, although I did for 10 years down on the exchange in New York. But now I'm more into the ETFs, and I'm particularly liking the USO because I'm finding it to be extremely technical. And essentially, after making a big move up in April and correcting and major moving averages, if you look at a weekly chart, it came back to support at 36 and held, and now we're coming in higher today at 36.91, and it's taking out recent resistance. So I believe that we can see a move up, maybe not back up to 38, maybe even higher over the next few weeks. So that's what I would be looking for.
Okay, and why did you make the switch from? Was it because they're technical? I mean, the crude market's pretty technical as well. Is it just you like the liquidity, or you just felt more comfortable trading the ETF?
No, it's just that because I have several hundred people who are paying me to trade with me, a lot of people are scared of trading futures.
Yep.
A lot of people don't have futures accounts open. And so really I find this to be the most comfortable sort of middle of the road place to put people's money who are following me.
Okay, that certainly makes a lot of sense here. You also had touched on a volume surge, the signal to blow off top at some of the small caps. And what might the inverse of that look like?
Well, right now, after yesterday's action, we had that blow off top in the small caps back in March. So, we've had now a couple of months since then. And then we had a bottom in place on Friday. From a technical standpoint, we did not get the volume to follow through, although yesterday on the rally, we did actually get some volume. So now, as much as that peak high in March predicted that we were action in the Russells, now what we're looking for was that it? And so I think the biggest indicator is that we got the follow through yesterday. We got some volume. It wasn't amazing volume, but it was good volume. And now we're going to be looking for that 200-day moving average to hold. And if that holds, I think that's going to be a very good sign, and maybe that was it for the correction. We'll see.
Where's the 200-day come in at?
And I hate to be so tentative, but it really has been almost a day-to-day scenario in this market when it comes to the indices because of this incredible diversion that's happened. Same thing in NASDAQ. We need NASDAQ at the party. I like to use that expression. And NASDAQ finally, after testing the 200, came back and cleared the 50-day moving average right into some resistance here. So if we can get a move back over, say, 88.20, then which we're coming in right now at 88.35 bid in the pre-market, then I would start to say that maybe that was it for the correction, and the spiders and the diamonds were actually trying to tell us something being ahead of the curve. So all the old relationships that we know, I think you can throw them out the window. And I don't know why, but they seem to me everything has switched. And that's why I'm saying that I also do believe that the market will actually find rising rates somewhat of a relief. They'll find the U.S. dollar rising somewhat of a relief. And we may even see things like oil, which apparently, in the past has been negative in that scenario, actually prosper from that, especially U.S. oil. So that's kind of all the stuff I'm looking for.
Okay. Now there's always rotation going on, and
I'm not hearing you.
you're not hearing me.
No, I hear you, but very faintly. So whatever just happened.
I think we have a short here or something. Emerging market rotation into country funds. Could you touch on that for us?
You know what? I can't hear you. I'm going to check my mic here, but how's that?
I can hear you fine, Michelle.
Okay, now I hear you better. You faded for a second. I'm sorry. So
I'm just going to stay in one place. I'm not going to move here. We're talking about, I just had asked you about the rotation into country funds in emerging markets.
Yes, and that has also been something that we've been very interested in, particularly India, Spain have been the two that have really been on the top of our list. And of course, India just had their elections, and that was obviously very positive for the IFN and the EPI, which are the ETFs. And EWP, which is the Spain, also been doing very, very well. Germany's been doing very well. EEM has also been doing very well. One of the companies that we've been watching in India has been Tata Motors, which has also done extremely well. So yes, I do believe that there's also where the U.S. market had been reigning supreme for so long, some of these emerging markets are catching up a little bit. China's still been a little bit of a disappointment here, although we're getting a nice little pop over the 50 today. We'll see how well that sustains itself to see if it can get going. I would love to see China playing some catch up here, but at this point, it's really still undervalued compared to a country like Spain or Germany.
Okay, but looking at some of the healthcare stocks of late, and you take a company like Merck that recently just made a multi-year high and is really pulling back. Some of these other ones, I know Lilly's holding up. Pfizer's another company that's come off its highs. I mean, do you see what are the emerging trends in healthcare, and do you think that Obamacare has changed the landscape for healthcare companies?
Oh, absolutely. And, we did a lot of research on that as well, on what healthcare companies would benefit from Obamacare and what wouldn't. And, the switch to HMOs was something that we were really looking for because a lot of doctors now were going to suffer in their private practice and join more boutique type of doctor operations. And so, we really kind of broke it down, and some of the companies that we have been trading is Hespera, HSP has been one, which has done phenomenally well. We've looked at Tenay Healthcare, which has done really, really well. And so those are the ones that we have been watching. Some of the other ones, though, have done very poorly, like you mentioned. Merck got killed. So I think you really have to understand where you're going to be. Anything that involved research got initially hammered because, again, the perception was that with Obamacare,
Prevention.
there would be money cut from doing any kind of R&D. Well, I don't know if that's true or not. Again, it doesn't matter whether I believe it's true or not. It only matters what the perception is. But anything that had to do with collective health care, home health care, anything that people would perceive would increase because of more access to health care has actually done well. So, that's the kind of thing that I have been looking at. And one of my favorite stocks that I have been watching all year has been Onvo, which is actually 3D printing of organs.
Oh, we've talked about that before. We've talked about that stock before. It's kind of fallen on hard times as late.
It really has, but keep an eye on that particular stock because I don't believe that there will be any major cut of research and development. I think, like I said, there is so much confusion around the Healthcare Act. Let's put it this way. I can't believe that would be something that would be cut. But also there has been a lot of coverage over the last year on 3D printing in general, but certainly 3D printing of organs and, cartilage as in ears, etc. And because this stock got so beat up, it actually landed on a very major support on a month moving average. I look at all time frames, month, week, daily, 30-minute, 1 minute. And that support that it landed on was down around $5, and now it's trading up at $6.40. That could actually have bottomed. So that would be something else that I would be keeping an eye on in the healthcare. If you're looking at HSP, that's all
had a nice run. Yep. Okay.
Running too rich. If you look at THC, that's still hanging out at we're also looking at CYA, which is, I'm sorry. What, did you want to say something?
No, I was just going to say we're running a little long here because you've given us so much good information on things that we don't talk a lot on the show here. Interest rates. Michele, thanks for coming on again, and your input is very good for our listeners, and we'd like to have you on again.
Thank you guys for bringing me back on and staying with me after our technical difficulties. I hope to be invited back again.
You will.
Thank
You will
very,
for
very
sure.
much.
Thank you,
really
Michele.
Day.
All right. Bye-bye.